during inflation are usually the best. They're the businesses that you buy once, and then you don't have to keep making capital investments subsequently. So you do not face the problem of continuous reinvestment involving greater and greater dollars because of inflation.
In today's economic climate, inflation is a hot topic, impacting everything from groceries to gas prices. For investors, high inflation presents a unique set of challenges. How do you protect your wealth when the value of money itself is eroding? In this video, we'll explore how to invest wisely during periods of high inflation, drawing insights from Warren Buffett and practical strategies that can help you not just survive, but thrive in these turbulent times. Understanding inflation and its impact on investments. Inflation is the rate at which the general level of prices for goods and services rises, eroding purchasing power over time. For investors, this means that the nominal returns on investments might not tell the whole story. What really matters is the real return, which is the nominal return adjusted for inflation. For example, if you earn a 10% return on an investment, but inflation is running at 5%, your real return is only 5%. This concept is crucial for understanding how inflation can stealthily erode the value of your investments. Warren Buffett has often emphasized the importance of real returns. In his 1979 letter to shareholders, he pointed out that a business earning 20% on capital could produce a negative real return for its owners under high inflation conditions, after accounting for taxes and inflation. Warren Buffett famously said, "A business earning 20% on capital can produce a negative real return for its owners under inflationary conditions, not much more severe than what presently prevail." This highlights the importance of considering inflation when evaluating investment returns. Historical context and Buffett's insights. To navigate high inflation, it helps to look at historical precedents. In the late 1970s and early 1980s, the US experienced double-digit inflation. Buffett's insights from this period are invaluable. He introduced the concept of an investor's misery index, which combines the inflation rate and the tax impact on investment returns. When this index exceeds the return on equity, investors' purchasing power shrinks even if the business performs well nominally. Buffett's wisdom from this era remains relevant today. He highlighted that inflation acts as an invisible tax on those who trust their currency, underscoring the need for investments that can outpace inflation. Characteristics of resilient businesses during inflation. Buffett has identified two key characteristics of businesses that perform well during inflationary periods. Pricing power. Companies that can increase prices without losing customers are well positioned to maintain their margins. These businesses typically have a strong brand or a unique product that consumers cannot easily substitute. For instance, many technology companies have products that are deeply integrated into their users' daily lives, making it difficult for consumers to switch to competitors even if prices rise. Low capital intensity. Businesses that can grow without needing substantial capital investments are better equipped to handle inflation. This means they can scale their operations and revenues without proportional increases in costs. Examples include many software companies, which can add users without significant additional costs. Investment strategies during high inflation. Given these characteristics, here are some strategies for investing during high inflation. Stocks with pricing power and strong moats. Look for companies with strong brand loyalty and the ability to raise prices without losing customers. Companies in industries such as consumer staples, healthcare, and technology often have these qualities. Scalable businesses. Invest in businesses that can easily scale their operations. Companies in the tech sector, for instance, often have the ability to increase their user base or sales with minimal additional costs. Dividend growth stocks. Companies that consistently increase their dividends tend to perform well during inflation. These businesses typically have strong cash flows and the ability to pass on costs to consumers. Real estate. Real estate is a tangible asset that often appreciates with inflation. Rental properties, in particular, can provide a hedge as rents tend to rise with inflation, providing a steady income stream that keeps pace with or exceeds inflation. Energy stocks. Commodities like oil and gas often see price increases during inflationary periods, benefiting energy companies. Investing in energy stocks can provide a buffer against rising costs in other areas. The role of personal development. While investing in the right stocks is crucial, Buffett also emphasizes the importance of investing in yourself. Enhancing your skills and earning potential is one of the best hedges against inflation. Warren Buffett said, "The best protection against inflation is your own earning power. The best thing to do is to be exceptionally good at something." By improving your professional abilities, you increase your income, which helps maintain your purchasing power even as the cost of living rises. Whether through additional education, certifications, or on-the-job experience, personal development can provide returns that no market fluctuation can take away. Tax considerations and real returns. Inflation doesn't just impact the nominal returns on your investments, it also affects the taxes you pay. Higher nominal gains can push you into a higher tax bracket, reducing your real returns. Strategies to mitigate this include investing in tax-advantaged accounts like IRAs or 401(k)s, which allow your investments to grow tax-free or tax-deferred. Additionally, focusing on long-term investments can reduce capital gains taxes, as long-term gains are typically taxed at a lower rate than short-term gains. Summary and practical advice. To summarize, investing during high inflation requires a strategic approach. Focus on companies with strong pricing power and low capital intensity. Consider dividend growth stocks, real estate, and energy stocks as potential hedges. Invest in your personal development to increase your earning power. Be mindful of tax implications and seek to maximize your real returns. If you found this video helpful, please like and subscribe for more insights on investing. Stay tuned for more tips and strategies to help you achieve your financial goals. And if you're eager to explore more about investing, make sure to browse through our other videos on this channel. Thanks for tuning in. Raise your IQ with cutting-edge info, insights, and analysis. Visit and subscribe for free at the link below.